Want to stop trading with one hand tied behind your back? Curious about a concept like anchored VWAP and why it can be so powerful if used correctly? Or are you thinking about joining a trading community? Not just because trading can be a lonely occupation, but because doing so can make all the difference in the results you see in your accounts. Well, you're not going to want to miss this week's Money Show Money Masters podcast episode then, because my guest is longtime trader and trading educator Brian Shannon, president at alphatrends.net. Brian, welcome to the podcast. Brian, glad you could take some time out. I know this is your first time on the podcast, actually. So why don't you start by talking a little bit about your background and what it is that Alpha Trends does for people who aren't familiar?
Sure. Mike, I started full time in the business in 1991 as a retail stockbroker in Boston. Started out at Lehman Brothers and realized I didn't want to be a telemarketer, basically, as a stockbroker, that my interest was trading. So long story short, I moved out to Denver also in 1992, actually, and started a trading firm in Denver for another company called Generic Trading. They were one of these firms that gave you leverage to day trade. So I started an office for them, and it wasn't just day trading, but it was swing trading. It was active trading. And that's where my passion has always been, is in active trading and helping to teach that to other people, because the mistakes that people make and the turnover in this business is really like any other business. I mean, we always hear about 9 in 10 restaurants fail. Well, or something like that. That's what you always hear in business school. Well, the same thing is true for traders, that most traders just don't have the skill set from the start to get involved and have a chance to succeed. So I've been trading full time since 1991, and I also created Alpha Trends to help other people. I've written a couple books about technical analysis, and now what I do on a daily basis is help guide people through the markets for the short to intermediate term trend. And I'll define that because everyone has a different definition of what short term and intermediate term.
Sure.
Intermediate term, so swing trades, typically up to 2 to 3 weeks, and it's really up to the market to let me know how long to hold things. So the idea is to listen to price action.
Yeah. Brian, there's a lot to unpack there, and I want to back up for a
Yeah.
minute and talk about longevity. What is the key to a trader surviving and thriving in this market? Or really, I mean, again, you've been at this for a long time, in any market environment.
It's without a doubt risk management. I always say risk management is job number one. I'm not the first person to say that. And a lot of people will say that, but they don't honor it. So you really have to have it not just as a tagline, but as part of your DNA. And it takes a while to get there, to get to the point where you just don't have an emotion about cutting a loser, because you realize that cutting that loser is going to save you a whole lot of money. And once your ego, starts to try to override it and say, well, we'll just buy a little bit more, get a better average cost and that sort of thing, then you have losses spiraling out of control, and you're fighting your way out of a big hole that you've created.
Got it. Well, in your kind of personal trading and what you do on Alpha Trends, I mean, you've touched on a little bit time frames. I'm kind of curious, generally speaking, what time frames do you like to focus on? What markets do you most actively trade? Futures, stocks, options, or pretty much everything?
Now, for the most part, it's US equities and ETFs, and I do a little bit of options as well, simply to manage risk. If I want to take a positional trade in a stock, but there might be some kind of catalyst or a little bit of heightened uncertainty due to, maybe the Fed's talking or something, strange like that, then I'll go into options where I know I can strictly limit my risk. But US equities are basically what I prefer to trade. And, that can be a $2 stock. It can be a $500 stock. It really doesn't matter. My minimum criteria is volume based, and I want to see a 20-day average of at least a 500,000 shares. If it does that, I'm not really interested in the market cap. I'm just interested in liquidity. Some people will say, I only trade this market cap or that market cap. To me, it's just about liquidity. So typically my time frame is anywhere from a day trade. I don't like to day trade. I don't suggest most people do it. In fact, most of my day trades end up being losers because I'm looking to get into a swing trade. And if my swing trade doesn't survive as a day trade, well, then I'm not going to hold it. So the idea is to get into a swing trade. But if I get stopped out that day, then it's a day trade, and therefore I, have more losing day trades. But in swing trade, again, I'll define that as what the market tells me, but it typically is, 3 to 4 days up to 2 to 3 weeks generally.
Okay. Let's talk a little bit about community. I mean, I know a big part of what you do, and frankly, a lot of trading educators these days versus maybe a couple decades ago are focused on things like Discord communities, the talking out of trades during the day and during the week. Why is that important these days?
Trading is, somewhat of a lonely business, and not just lonely, from a social perspective, but people have a lot of questions. And if they can find guidance from someone with more experience that can help them think through a situation, then that is important. So, for instance, with Alpha Trends, I have 4 goals that I state. One, I want to help people make money. Two, I want to help them avoid losing money. And, that's actually one of the main things that ends up being people are, look at a stock down 3%, 5%, and they want to buy it and buy it and buy it. And, I always say, don't buy the dip, buy strength after the dip. So trying to help them realize the optimum place to buy. Third, to educate. So I provide a ton of education through Twitter, stock twits, Twitter and stock twits, as well as Alpha Trends. And I do have a Discord, and the goal there is to create a positive environment where we're, talking about value added. It's not just about, hey, 8 out of 10 times the market did this, that happened. It's about, okay, well, let's look at how it's setting up today, and can we use that information to help us make money today? So all the goals kind of tie together just to, create a healthy environment for people to thrive in.
All right, let's talk about some of the tools and strategies that you use. I mean, I know you're big on the concept of anchored VWAP. Can you talk a little bit about what that tool is, how it works, and how traders can apply it to their own trading?
Sure. Let me just back up real quick first, because before you can add any tools, whether it's an anchored VWAP, a relative strength, MACD, or anything, you really have to start with the basics of market structure. And Stan Weinstein did a fantastic job of that, as did Wyckoff, who preceded him. So just understanding, are we in an uptrend? Are we turning sideways? Are we in a downtrend? Know where the odds are from a structural standpoint and multiple time frames. So just because we're in a big uptrend doesn't mean that you can just buy anywhere. We might be, in the middle of a 15% pullback. And if you bought at the peak, you're not going to be looking at that weekly chart saying, hey, it's okay, we're in a long-term uptrend. You're going to be feeling the pain of down 15%. So it all starts with market structure.
Yep.
Then the tools, the most important tool that I use, as you mentioned, is the anchored VWAP. The volume weighted average price is what I call the perfect combination of price, volume, and time. Only price pays. So that is, the final scorekeeper. We're trading for price action. It doesn't matter what the Fed said or what the CEO of this company said. If the price moves in our favor, we're right. If the stock market moves against us, we're wrong. And all the reasons in the world that you're wrong won't help you. So price, volume tells us the intensity of the commitment of the participants. So what we want to see is a healthy stock advances on increasing volume. That volume typically peaks right at the top of that short-term move, and then diminishes. If it's healthy, the volume diminishes on a pullback. So what we want to see on that pullback is we want to say, okay, are the buyers regaining control? So we put tools on there like the anchored volume weighted average price. So what we want to see is who has control. How do we measure 100% objectively who has control? That's what the volume weighted average price does. It says basically the cost basis for everyone involved in this market since that peak, for instance. Let's say it ran from 25 to 30. So we
Yeah.
put an anchored VWAP at 30. As it pulls back to 27, we're still below that VWAP, but the VWAP starts to turn sideways, and we get back above that VWAP of 27. That tells me that from that highest point paid for this stock on the recent move at 30, the average buyer who's been averaging down is now making money. That's 100% fact. It's not an opinion. That's the average price adjusted for volume. So every single share counts the same. It also tells me that the average short seller from that 30 level on down is now losing money. So the buyers have control. It's up for them to, and it doesn't mean just buy there, of course.
Yeah.
It means now we have to say, is there acceptable potential reward for the perceived risk? And if so, where do I set my stop? Because again, risk management begins with what if I'm wrong right from the start? So the anchored VWAP allows us to measure from any point, an earnings report, a Federal Reserve announcement, CPI, whatever it might be, to say who has control. So the buyers or the sellers. And again, it tells us that with 100% objectivity.
Yeah. Anything else when it comes to some of the common indicators that people use, the tips or pointers you've kind of picked up over your experience? I saw an X you recently mentioned something about, when I tell you the simple moving average is better than the exponential, trust me, for example.
Yeah. Well, and I was referring specifically to the 5-day moving average. So for me, in an intermediate term, one of the best tools for the intermediate term is the 5-day simple moving average. And, I don't care if people use a simple or exponential, but because they're basically going to be in approximately the same area. And if you use them as a strict buy sell, I think you're using them incorrectly. But to say, who's starting to gain control. So that 5-day moving average and the simple, there are reasons that the simple is better for the 5-day. And it's actually interesting that I don't use the 5-day on a daily chart, only on intraday timeframes. So it's a true 5-day rolling average. So if you were looking at a 5-day moving average on a daily chart, you would, let's say at 9:31 a.m. as soon as the market opens, what you'd actually be looking at is the average of the last 4 days plus 1 minute today. It's not until the day closes that you get a full 5-day average. So when you use intraday periods and do the conversion of there's 1,950 minutes over the course of 5 days, you start to convert that, then you have a true 5-day rolling average. And those are some of the things that I talk about in these presentations and online, Twitter, and everywhere else where I do my work.
Got it. I have to ask a little bit about this market environment. I mean, clearly it's a more volatile environment the last few months, and not just from a number like the VIX and where it's averaging now versus rolling back to the last year, but just in general, this two-way volatility. What do you do as a trader, and what do you advise people who listen or follow you to do in a market like this where volatility is high and rising?
One thing is, cut back on your share size. We're not in that strong bullish environment that we had been in. The market is less forgiving of the mistakes that you might make and the bad habits that you might have formed when we had a runaway bull market. So understand, it's not always an easy environment to make money. People get spoiled by those easy environments and they think they're going to last forever, and they don't listen to the message of the market. When the market starts talking and saying, hey, we spent 3 full weeks below that declining 5-day moving average, don't buy while we're down there because the sellers are still in control. Instead, look for tactical short positions or just wait, sit on your hands because cash is a position as well. So it comes down to really just understanding what your time frame is. Mine happens to be swing trades and shorter term, so I don't really have to worry about those larger gyrations. I mean, for longer term money, you've got to understand as a psychology of put it away and let it do its thing, versus trading is more nitty gritty, and you're fighting in there each and every day. But make the fight easy. Don't tie one arm behind your back and consciously. And that's what you're doing by buying stocks and downtrends, is setting the odds against you. Look to improve your odds with just basic technical tools.
Brian, I know that as a technical trader, things are going to change, market's going to change. What you might like on any given day, you might not like a week later. But I'm curious if there's anything that you're seeing in this market that looks particularly attractive versus maybe something that looks something you'd stay away from. And that could be ETF, stock, asset class, whatever you feel comfortable talking about.
Sure. I mean, I can talk about anything really. But I'm looking at the semiconductors, and the semiconductors have really led this market higher. They typically lead up and down, and now they made a new all-time high late last year, and we've kind of been under pressure since then. The problem with this group right now is if you look at a weekly chart, we're below a declining 200-day moving average, and if you go back and look historically, you'll see that typically rallies do not are just bounces when we have a declining 200-day moving average. So I'm looking at these semiconductors and saying they're going to need time to heal. If they're not going to continue lower, which seems like the path of least resistance right now, they're at least going to have to turn sideways for a while to heal and correct some of this damage that's been done. So keep an eye on those and look for, if we start to, rally up, see these, 5-10% rallies, and then they start to roll over again, the market's telling you, here, be aware that we're losing leadership, and that could impact the broader market as well.
Okay. Anything on the flip side that again looks more bullish to you or more constructive?
Man, that's a tough one. I wish I could say yes. I mean, bonds, maybe they're pulling right back into their 50-day moving average of the year-to-date anchor right now. I don't own any yet, but they're kind of carving out an inverted head and shoulders pattern. And they, right now, today's March 25th, they look like, maybe that if they start to stabilize in here, that the bonds could start to rally again. But I mean, gold's at an all-time high. You could look there. Um, uh, Southwest Airlines just refuses to pull back since they reported that they're, charging for bags, but their earnings are basically going to double over the next year by adding that baggage fee. So there's a real strong bid in that since the earnings. Those are some of the places I'm looking, and then just individual stocks that I don't have confidence are going to be leaders, but that can trade, for my time frame.
Sure. In the time we have left, I mean, obviously, we're speaking because you're going to be joining us for the Money Show Masters Symposium in Miami. I found the title of the presentation really intriguing. Swing traders don't want to buy the dip. Without giving away too much, I mean, anything you can, maybe a sneak peek of what attendees are going to pick up in a presentation like that?
Sure. Well, I'll talk about market structure because I think you always have to begin there. And then I'll talk about the 5-day moving average. And just basically, buy strength after the dip. Let other people do the dirty work. Let the institutions go in there and start to, cover their shorts and then bring in newer buyers and let the market at least establish some support before you go in and buy. Ideally, what we want to do is we want to buy as the buyers are just gaining control. So if we go back to our anchored VWAP stock that pulled back from 30, it might have, touched 26 and a quarter, rallied up to that VWAP at 27, pulled back to 26.75, and then breaks past that VWAP at 27. That's when you want to buy because that's when the buyers have control. Be on the winning team. Be a fair weather sport. Be a fair weather fan. Let other people do the dirty work. Don't use your money to help create the low. Let other people do that and then enjoy the ride in a low risk way. And hopefully, if the market agrees, you won't get stopped out initially and you'll be in a position to raise your stops and participate in that emerging strength.
All right, great. Well, Brian, thanks again so much for your time. I appreciate you taking some time out to chat. Viewers, if you're watching this, as a reminder, Brian is going to be joining us at the Money Show Symposium in Miami. It's our second annual event, actually, there, right alongside the Miami River downtown. Couldn't ask for a nicer venue or a greater program that we have planned. So check out the details in the description below. Go ahead and register if you're ready. And Brian, thanks again.
Thank you. My pleasure.